All right, everyone, welcome to our webinar here at Newpoint. Uh, we will get started here as we add guests to our presentation. But without any further ado, I'm Ken Yeager, CEO and founder of Newpoint Advisors Corporation. Throughout the conversation today, you'll hear from special guest Mary Hamilton, CEO of Mad Data, and Deborah Zukonik of Dare Capital Partners. We have also Paul Shapira, Senior Managing Director, as well as Matthew Brash, Senior Managing Director here at Newpoint, who have deep industry expertise in financial advisory services for small businesses, who will also be offering up their opinions as well. They'll provide you with a quick overview of the top 4 industries to watch in Q4 and what to do about it. And then we'll transition into some Q&A discussion where we encourage you to ask questions in the chat as well. So if you can look down below at the chat buttons, we'd be happy to entertain those questions as we go along. Without further ado, let's get started on our conversation. All right. And we are here. We are a small business that exists to help other small businesses, if you will. And so with our, if you will, not only our knowledge, but a bit of our empathy about what it's like to run a small business, we want to offer up our insights to folks. Our job is to turn around small businesses, financially underperforming companies between $5 and $50 million in revenue, who are somewhat, as we say, underperforming or distressed. We're hosting this webinar as one in a series about how to intervene before it's too late, saving companies, saving assets, and certainly one of the main things that we follow here at Newpoint, saving jobs. At the end of this webinar, you should be able to walk away with Q4 outlooks on these industries, the challenges they're facing, and strategic counsel on how to guide your business through those particular issues that might be appearing in your industry. And in a moment, you're going to hear from Paul Shapira and Matthew Brash, 2 of Newpoint Advisors experts who coach small businesses through financial challenges, and from Mary Hamilton, Mad Data, and Deborah Zukonik of Dare Capital Partners. And with that, we will get started. So, as I said, chat down below, and then we're going to get rolling on our conversation. So, with that, the first person I want to talk to is Deborah. And Deborah, I want you to give us a brief, quickest background on you, but also talk to us about the signs of distress and patterns you are seeing with your clients in the construction industry.
Well, I've been in factoring for 40 years, and for about 36 of that have been servicing the construction industry. We started in 1989 in the construction industry, so it's been quite a few years. And we've had the ups and downs in the construction industry through the years. This is probably one of the toughest times that we've seen, more from the interest rate environment than anything. I believe that slowed down a lot of the construction jobs that were already planned. Obviously, when we first started doing construction years and years ago, interest rates were extremely high, but that was the norm. They were low for such a very long time that people, came to think that was going to be forever. And so it really did affect construction starts when interest rates moved up significantly. But we are seeing some people getting confident now that they're coming down and they've started projects and they're moving forward. The infrastructure bill also helped some of our clients because some of the construction that they do are road construction and other types of infrastructure that was covered in that bill. The problem with those jobs are most of those obviously are managed through the individual state Department of Transportations. And those states are very stingy with the money. And so the jobs are very, 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 very thin. It's been very difficult for our contractors, many of which have had many, many years of doing road construction, to be profitable during this time. The good thing is that now some of our clients are seeing, like I said, some of those the normal commercial building construction, including some of the projects that have to do with public service, like turning buildings into housing for the homeless, and just providing resources that places did not have, just to serve that population. And so many of the things that we're seeing that are being built now that are covered by, I would say, government money, are in that category, and they do have profit in them. And the companies that are doing those things and working for both and working for other commercial entities are doing much better now. It's been very, very slow for a couple of years, but it actually is picking up just in the last quarter. So,
Okay. Very, thank you, Deborah. That's a very healthy and great start to the conversation. What I want to do is also want to feed in a couple of other thoughts from other people and the other industries, and we're going to kind of circle all this into kind of a big cabal of a conversation as we move forward. So thank you for getting us kicked off. All right. Well, next we want to talk with Mary. And Mary's in the IT space. And what we want to do is ask her a little bit about the patterns that she's seeing in the space, as well as what her clients are telling her or what they're doing in terms of the challenges they're seeing in their space. So Mary, let's have a word with us, please.
Absolutely. So, just listening to the previous conversation and going forward, everybody has felt the increased pressure of compliance being driven by government regulation, that they're imposing compliance within the financial sectors, the health sectors. It's expanded to the auto industry, it's expanding into managed service providers. So the amount of cybersecurity that companies have to have now, even from their insurance providers, you're going to continue to see an increased cost in that. So what does that mean? Great. Like the concept for most people is that IT is, they don't want to pay for it. They don't want to invest in it. They don't see the purpose in it other than I have my computer. So as long as the computer's working fine, we're golden, and you have email. But to add cybersecurity into that, the cost is what is that we have seen continuously affecting multiple industries, and compliance adding more need to have cybersecurity in order to be in compliance with government regulation, in order to have cyber liability insurance as well on there. So the costs continue to increase, and that is because, unfortunately, we live in a world now where a threat actor from the other side of the world, can destroy your entire life, your entire business by the click of a button. And it's not slowing down. So we have ransomware, we have complete update failures like the world saw with CrowdStrike and their update that broke the world. So the need and our dependency has increased across every industry on technology. Thus, the need for cybersecurity has only been expedited and expanded. And that's not going to slow down. It's only going to continue to increase.
Good gosh, that is a lot. It sounds a bit like another factor of what we'll call inflation, where
Yep.
nobody was really expecting that sort of cost increment, to their business. But it's very real. I do appreciate that. Thank you, Mary. And again, we'll kind of building all this into a larger conversation. So I'm going to turn it over to Matthew, and Matthew's going to take a moment. If you don't mind, Matthew, talk a little bit about what you've been seeing in the food services and accommodation space that you've been dealing with recently.
Sure. And thank you, Ken, and nice to be on this panel with everybody. There's no secret that the food industry, hospitality industry was one of the sectors that got crushed by the pandemic. And of course, although things have come back to what we'll call a normal, the tail effect has still continued to affect this industry greatly. The food industry is no stranger to changes and challenges, especially after the turbulence of the COVID-19 pandemic. Several problems in the food industry remain to be addressed. Shifting priorities, labor shortages, safety concerns, changing consumer demands, which is ever changing, and other issues and challenges faced by the food and beverage industry. And as I said, the big thing is labor shortages and staffing issues, from high turnover rates to difficulty attracting new workers, demanding working conditions, and now even limited benefits are adversely impacting restaurants, establishments, hospitality setups of all shapes and sizes. We have obviously dealt with several different, even hotels that we are working on reorganizing, where their restaurant space is vacant and empty just because of, let alone staffing issues, and in addition, high rent costs that are out there that are due to some landlords and other property owners that are trying to catch up on all the deferral and reorganization, restructuring of leases that are now catching up and coming due. Rising food costs. Over the past 2 years, food costs have almost doubled. Inflation is prevalent for everyone, has dramatically impacted the hospitality industry. And even those food production costs increase due to labor turnover, investments, food safety regulations, climate changes, supply chain distributions, a whole plethora of reasons that is generally affecting the food and hospitality industry. Mary was talking about technology. Nowadays, IT plays a big part in point of sale systems and other ways to better manage your business. But that IT software is a pretty big cost to not only install, but to maintain in not only just restaurants, but food suppliers, manufacturers, several other industries that some of these vendors, customers, potential clients can't afford. The other thing I'll mention is consumer preferences and changing trends. Consumer behavior constantly evolves, rapid shifts in dietary choices, growing demand for certain plant-based options, increased focus on sustainability. The different models are ever changing, and restaurants, hospitality industries are all being impacted and have to be able to evolve and adapt to keep up with these various trends to stay alive. I mean, just in 2024, some of the largest fast food or casual restaurants have filed bankruptcy because of these problems, which we have fortunately and unfortunately have been a part of, and it continues to be a problem that hopefully can be curbed in the near future.
Great, Matthew. Thank you for getting us started in that area as well. Next, if we have our technology going in the right direction here at Newpoint, I want to ask my colleague, Paul Shapiro, who spends a lot of time out of the Detroit area, talk to us about manufacturing and one of his favorite topics, the automotive space.
Sure, Ken, I'd love to. Like the other spaces, manufacturing either is going really well or it's not going well. I'd like to touch on 4 themes today that focus on automotive and EV. First theme is when you look at the Purchasing Managing Index, which is a measurement of manufacturing activity. Over the last 42 months, the PMI, which is called, has decreased from a high of 64 to a low of 47. It's about a 30% decrease. And being below 50 indicates we're in an economic contraction and shrinking of manufacturing economy. I'd like to also point out challenges in the automotive and EV space are due to the United Auto Workers contract that was signed in the late 2023, where wages are increased 25% over the prior contract. A lot of these costs are passed on to Tier 3 and Tier 4 suppliers, and they burden much of the extra cost, and it's a very tough burden to shoulder. The other couple of things I want to point out in the automotive and EV sector is you have a reduction in retail consumer demand. You have credit card balances up 48%, which is about $300 to $400 billion. Delinquencies are up about 29%, and automotive loan balances are up tremendously, and also delinquencies. So you're seeing a retail consumer demand decrease and the inability of consumers to actually go out and spend more money. And lastly, affecting automotive and EV, like to talk about purchase volumes and production levels, which are decreasing. CapEx for the Tier 3 and 4 were spent on higher volumes, particularly EV. Auto sales are down 10% this year, and EV, as everyone knows, continues to soften outside of Tesla. And the EV softening is expected now to last in 2026. So you can see there are numerous headwinds, both the manufacturing and the automotive as a subset of it are dealing with. And overall, this is good. This is leading to a slower economic growth and actually contraction in that space.
Great, thank you, Paul. So that's very helpful as well. We've all right. So we've now kind of put all four industries on the table here. These are ones that we've selected as ones that have been showing signs of issues that are either emerging or, if you will, have been a drag. And as we know from, even though a rising tide may raise all ships, we do still find ourselves finding sectors where people can't, where I like to say, hope is not a strategy, and there's still going to be softness or issues for some players in those sectors, more than they say would be the case for just your average client who is just getting fatigued and tired and falling behind. With that, I want to parse a little bit of where Deb came into this about the construction industry. And Deborah, we've all heard on on the building side of the world, or the rent and lease world, about the commercial building issues in certain urban environments. But tagging right along behind that has been sort of this quiet little creeper, but also kind of the darling of the construction industry, which is the multifamily space. And I'm wondering what you've seen in that space that's working or not working amongst your clients or of those who are prospects for you guys.
Actually, that's the one area that has been working recently. It was really in a downturn during the, pre-COVID, because there were with the interest rates being so low and housing starts were so, so up so greatly. I mean, like everywhere was building homes. And so the multi-housing really was down at that point. We did not see as many of those projects going in unless they were tied to huge retail complexes as well. A lot of high-end multi-family prior to COVID tied to retail projects, big retail projects. However, those have really kind of gone by the wayside, and we are seeing multifamilies going in now more along the line of not high end, more of a mid-range and lower range, because there's a demand for it. People are not able to buy houses now with the interest rates being what they were, or what they are still, because it hasn't dropped yet. But those interest rates being what they are, people just can't buy houses right now. And with the economy overall being what it is, our money doesn't go as far as it did. And so a lot of people are looking for housing in multifamily now. And many people have lost their homes to this situation. So we're seeing those being built, but they aren't the ultra fancy developments with a lot of high-end retail around it like we saw pre-COVID.
Gotcha. Okay. And Deborah, along those lines, are there regions where if you get a contractor that comes your way, you're more suspicious or more careful with the credit than other regions? Or is it really not the case?
Well, there are, simply because there's issues in building in different spots. So we very rarely take a large construction contract or contractor who's in California. If it's really hard to be a contractor there for many, many, many different reasons, but mostly because of California laws and their taxes. And so it's just can't be profitable. And so most of the contractors in California went by the wayside that we were funding, and several others that I know went by the wayside during COVID. We've had very few clients that have come on board in California since then, or not because we haven't had them apply, but because we haven't been able to approve them. I mean, they're just a very, very difficult place. But overall, South Florida and Manhattan and basically California are the three toughest places for us to finance contractors. Just from a building perspective, it's just very, very difficult. They have a very difficult time making money. Manhattan's always been like that. It's very expensive to build there. It's very expensive to be a contractor there, and the margins just aren't usually there. And so a lot of contractors, unless they're extremely well established, just can't do that successfully. In South Florida, there have been a lot of major issues with contractors, and we have found that the ones that we have attempted to work for were not of the perhaps quality builders and using the types of processes that you should use to have successful projects. So it's been a place that we've had to not go often simply because we can't find, there's no real true strong contractors there that are strong enough for us to be able to fund and not fully bankable and being a national contractor. So Florida is a very difficult place.
All right. Very good. Thank you for that input. Mary, keeping with our kind of our ladder of conversation here, I wanted to go back to where you were with cybersecurity and the inflation there. I imagine that there is some counterintuitive behavior that's going on with some clients, where we're up, our backs against the wall technology-wise, but our backs against the wall cash-wise. And what kind of decisions are people making, and how are you guiding them through that?
The biggest pullback that we see is as the economy, and we were already predicting this to happen this year. It's a cyclical, it's an election year. Everybody kind of saw the writing on the wall. So what we've been seeing is with the inflation of it, with the cost, people are now cutting services, right? So they're cutting what type of cybersecurity they're getting. They're reducing it to a very base level. So the bare minimum that will check the box. And with that, it's like, cool, you can do that. So you have to be creative, right? And with this, anytime that there's a pullback in service, whether that's fixing the expectations to fix problems quickly, to budget for hardware refreshes that come up, like in October of 2025, all the updates from Windows 2011 are going to, like, you have Windows 10 is going to go out, and Windows 11. So you have to upgrade, and you're going to have to get the new OS to go on the devices. So starting to plan for them, provide the value of helping them through these challenging times, talking to them about ways that here's how you can be secure, but you understand that you're going to assume more liability. And what we typically see with this is we start to see employees being jobs lost. And then we know the conversations that are going to come next because they're losing revenue. So they're looking for ways to save money. So trying to help them through this to give them the protection that they need and the service that they need so that they can continue business without financially breaking them.
Gotcha. And so some of them are making the choice not to go into choosing not to take on cybersecurity or dumb it down so far that they're at risk.
Yeah. They're willing to take the risk for compliance because the reality is the chances of being audited by the government are pretty small at this point. So you look at the auto industry with FTC safeguards that were implemented in June of 2022 and then again in December of 2023 this past year. There are so many people they're like, I don't care. They're just not going to do it. They're willing to pay the fee than to pay the cost for cybersecurity. And you don't see it as much in health. It depends on the industry. So healthcare and financial tend to spend, but they're still willing to take on more of the risk than pay for the delta of it.
Oh, that sounds like a trip to
Sad.
Las Vegas.
It is. It's like, let's not lock the front door. Let's keep all the windows open. Let's just, maybe put a sign outside and hope that the burglars don't come. Yeah.
That's a breathtaking to find entrepreneurs having to make those bets.
Yes.
All right. Well, before we go on to any other IT conversations, I'm also going to circle back also with Matthew Brash and bringing up another topic. Matthew, you banged into the inflationary issues, but one of the things about trading down has also been where you trade down in terms of your cost as a consumer. And one of the things that we've noticed is there's a trend with some of the bankruptcies that are coming up. Can you expand a little bit on that in terms of what we're seeing and who it is that's filing and why we think that might be the case?
Sure. And, we've at Newpoint have handled several of these fast casual chain bankruptcies as a financial advisor and steering them through, kind of the pandemic and issues that are facing it, and have a pretty good firsthand look at, some of these issues. As I said earlier, some of the bigger chains have filed bankruptcy in 2024. You've got Roadie, which a lot of it was caused by half of its locations were in downtown business districts. And because of that, because of people working from home, people not coming back to the office as much, their business and their overall revenues decreased quite a bit. Buca de Beppo, they blame their financial difficulties on rising costs and labor challenges. Not the Red Lobster was one where they had this endless shrimp promotion in 2023, and they just got absolutely crushed on it. So although it lasted for a while and it brought people into the restaurant, it ended up actually causing further harm than good. And in addition to that, more of a less obvious culprit to the outside, but more to turnaround professionals and other service providers in this whole industry is the leaseback agreements that were made under management ownership, deferral of rents and costs that were pushed out and now are coming due. So several of these issues have led to just a perfect storm of unfortunate activity of these restaurant chains having to pull the lever on Chapter 11 bankruptcies throughout our country.
Great. Thank you, Paul. One of the things that or Matthew, sorry, one of the things that I have seen pop up too, and that is the age of the brands that we're dealing with. So you mentioned Red Lobster. There are a couple of other names in the public space. We won't go too deep in it, where it appears while we're trying to make the decision to shrink our wallets, if you will, or do something with the shrunken wallet and still go out on date night or do some other activity, we're finding these large chunks of population, let's say like the baby boomers, aka the boomers, whose children aren't choosing those brands. They're sort of, they're not the up and coming cool stuff. And so when people are, you're not getting that someone trading down who's younger, trading into those spaces. Is that contributing, do you think? Are we losing butts in seats as well?
Yeah, I mean, that definitely is a theme that you're seeing and really across a lot of different industries with baby boomers. But in addition to that, even the next generation, the younger generation who are becoming business owners and opening up what they think are very cool, neat, new type concepts. One of the American things are, if it works, just, let's blow it out. So, you've got one location that is absolutely crushing it. You think, all right, if it's going to crush it here and it is just driving in a ton of revenue, let's just expand. And so we're finding that expansion is very expensive. And when tied to the pandemic, it truly just provide a crushing blow. So for example, Kuma's Corner, which is a Chicago staple as a burger joint, in a bankruptcy that we're a part of, they really suffered from, as I was saying, not only just their leases and expanding into very expensive neighborhoods in Chicago, but they also expanded to other states and found that concept, although they have delicious food, was not really well received in those different marketplaces. So I agree with you, Ken, that you're seeing it from the various sides of the spectrum, from your baby boomers even to your younger generation.
Gotcha. Well, thank you. All right. So moving away from that delicious topic to manufacturing. And Paul, what you and I have been watching is a struggle with labor. We've got one particular client recently who is, the floor was just full of people that really weren't qualified to do the work. And it was very, very technical work. Is that an exception, or are we staring at a trend?
Well, I think we're staring at a trend. When you look at the loss, you look at qualified workers retention, there's also the loss of qualified workers. and manufacturing, and I think actually construction is one other area. When you lose those qualified workers, it's very hard to get them back. And it's very hard to get back at the level of quality you need those qualified workers. And additionally, the cost of attracting them back and training them and then retention is even higher. So that whole process, that what I would call this labor cycle, is very expensive. And you end up losing top talent. And the only way to keep them, if they're not going to be utilized, is to just pay them to stand around. So you end up, at the end of the day, your costs are increasing when you lose those workers, and then retention and finding them as well is a very expensive proposition.
Absolutely. I'm struck by the lack of training facilities or training opportunities for blue collar people because we've been shipping everything overseas. Didn't matter, the job goes away, train them away. But you also bring up a really interesting thing that we've seen too much of, which is the preciousness of labor, and people, as you said, sticking around with that labor cost. And if you could make a quick comment on what we've seen from a cash flow perspective when you do those sort of things.
What comes to mind, though, is actually a situation that we've seen where on the opposite end, you have clients that have shrunk down on the revenue line, but haven't shrunk down in the same proportion on their corporate line. So those companies start to really have liquidity issues. When it comes to the issues with rehiring or trying to reattract labor, I think usually what comes along with that is a higher cost, and that causes liquidity issues. So either way, those liquidity issues, it's just from which side do you come at it.
Yeah. All right. So I will remind our folks, we are starting to get close to our wrapping up. And if that's the case, as that is the case, we would like to see if there's any chat ideas or questions anyone has. I want to encourage you guys to write those in the chat so we can bring those to our panelists. But with that, so while people get busy typing in, I wanted to come back around to you, Deborah, sorry, and ask a little bit more about the on the construction space. What from a Dare Capital perspective, how broad what are some of the ideas? We talk about construction and construction capital. The best way to describe this is there are different types of people who do progress billing, which is a very complicated working capital issue. What are, besides pure construction, are there other industries that you guys dabble in to do the where progress billing is a part of that?
Well, maybe not progress billing in the same strict sense that construction is, but we do have several clients that they bill as they are going through a project. One of them is, IT services. There's very few of them, but one of them is IT services that do that as well. They're in the middle of building out a service, if you will, an IT service, and they do that in tranches as well. It's it's not like in the same vein as construction, but it is, as they get certain portions of the job completed, they're able to bill. And so we see that in IT, but mostly it is just construction. We don't see that in a lot of other industries yet, thankfully.
Okay. Well, great. All right. Let me take that conversation about IT that you brought up and go over to Mary. And Mary, I have a question for you to start off with. You mentioned inflation or the inflationary costs that are coming with the impact of cybersecurity issues and related issues. In the big economic pool, we can go out and look at what the impact has been to GDP and talk about the true inflation numbers. But can you give us a little sense of what those year-over-year costs are looking like in the IT space for 23 to 24, or maybe the last 3 or 4 years of trend versus?
Absolutely.
Yeah.
I think that what people have misjudged is understanding what percentage of the budget it actually is. And so for years, IT information services, or information technology services typically was about 2% of the gross revenue, right? Like that's how people budgeted. With cybersecurity coming into play, with frankly, the cost of hardware going up, what we're seeing is anywhere from 3 to 5% up to 6%, depending on the industry. Manufacturing typically is more dependent on machines and hardware to run the company. So we see more cost there and in healthcare. But the typical budget over the last several years, really in the last 5 to 6 years, the increase just with cybersecurity has gone from roughly 2% to, 4, 5% on average for the customers that we take care of. And the overall increase in our industry for small businesses is about 15% year over year. I mean, the projected growth of my industry is 15% minimum every year that companies are growing because the need is there. And so there's also a job shortage because when you talk about labor, trying to fill the gaps with people who are skilled in cybersecurity that can actually help, that's another cost factor because the cost to have good qualified labor that I think Matt and Paul were talking about, that cost is so expensive for small businesses to be able to bring in. And this is so here's some common sense stuff, right? That people don't think about. They're like, well, we can have somebody do cybersecurity. It's easy, right? Sure, cool. Like for a small business to be able to bring in a security analyst, 150K a year minimum, right? To bring in a chief information security officer, that's anywhere between $100 to $200,000 a year. So you start to stack up your costs, and that's where the small businesses, they can actually do better with companies like managed service providers, people who have the whole skill set across the board to be able to drive that cost down to deliver to actually meet the budget so that it's not as it doesn't feel as painful. I'm used to giving different analogies, but I don't feel like they're quite as appropriate for this group. So painful tends to be a better word for them. So yeah, it's going to continue to increase, and that's just unfortunate. But that is the inflation of the threats that we face now in the digital world.
Gotcha. All right. Well, thank you very much for putting kind of a fine point on the pain, the level of pain in this space as well. What I want to do is it's time for us to wrap up, and we had a couple more questions. I'm going to pick just one more, and Matthew and Paul, I'm going to have you kind of chime in here as well. So what the question is, what are the trends we're seeing with commercial lenders in business lines of credits? Is lending still, is it easy? Have traditional lenders been conservative and consisting in values? So values and collateral. And I'll start it off and you guys fill in the nuances. Since we're talking about commercial lenders, and we'll speak about what we're going to call tier one capital commercial lenders from the FDIC franchise world. That group has not been growing. It grew really fast and it's been growing for the last 15 years, ever since the great financial crisis, but it's definitely leveled off here in recent times. Not for a lack, though, of wanting to go out and lend. So there's a dichotomy we're living with. We've got the tale of two cities. They're out there very enthusiastic, trying to drum up debt, but there's a little bit of conservativeness going on, but they're definitely telling you the door is open. At the same time, we're watching on the back end where lenders start to talk about how the portfolio health is. It didn't seem all that terrible until 2014. And it's been like a slow leak, a very tiny leak for the last 2 years. And finally, in about Q2 of this year, we start to see the banks reporting on a healthy dose of criticized credits starting to rise up very quickly, not picking any particular industries when they do that, but definitely starting to see that trend. And in reverse order, Paul, I didn't know if you had any comments on the commercial lending fractures you might be seeing.
Sure, of course. What's interesting is during COVID, everyone got a lot of money, obviously, and all the commercial lines of credit got paid down substantially. Some got fully paid off. So the outstandings on borrowers' lines went way down. Now today, as all that money has gone away, companies find themselves borrowing more and more where liquidity is tight. I think that's important to note. There are a lot of lenders who are starting to see their credit committees pull back. You talk about a criticized loans, very on point topic. If you look at the criticized loans for the top 20 banks, quarter 24, first quarter over first quarter 23, every one of the top 20 banks had an increase in the percentage of criticized loans and the percentage of non-accrual loans. And that goes across the border. And in those top 20 banks, 67% of what we call the commercial and industrial loans are at those institutions. So when every bank in that top 20 is showing a trend of poorer health, if you will, that's a real signal that, there's trouble brewing on the horizon.
Yes. All right. Well, Paul, thank you for putting a fine point on that. And Matthew, I'm going to give you the final word here on our webinar today.
Yeah, I mean, as it relates to the commercial lenders, we've had actually in the last week a couple of clients that have paid off their commercial lender, but using alternative, third-party lenders in those sectors. I met with one of the head of workouts at a large bank in the Midwest yesterday, and he was basically saying that, they see that there's still loans being made, but a lot of the takeouts have been on that next tier, as we so call it. As far as just final words, just want to say thank you for letting me be a part of this panel, and look forward to the next one.
Thank you, Matthew. All right. Well, that is going to wrap up our presentation. Deborah, Mary, Paul, and Matthew, thank you very much for helping contribute to today's conversation. Thank you to everyone who logged in and participated today. Loved the questions, very appreciated. And also thank you for giving the time to us. Hopefully there were some nuggets in here that will help each of you do better with where you're headed with your work. But last but not least, we will be mailing out a link to this entire presentation with a full recording so that everybody can follow along any notes that you need from today's conversation. And with that, we are completed and adjourned. Thank you.
Thank you.
Thank you.